Hello and welcome to the lecture for part 2 of chapter 17. In this section, I'm going to talk about the audit opinions for publicly traded companies, so companies whose shares are traded on the New York Stock Exchange or NASDAQ or that sort of thing. I'll talk primarily about how it differs from the audit opinion letter that we talked about in the first part of the lecture. After that, I'll talk a bit about different types of modifications to the opinion letters. So unmodified opinions with different caveats, talk about that. And then I'll talk about qualified opinions, adverse opinions, and disclaimer opinions. And then I'll conclude by talking about using other auditors, component auditors. So maybe another auditor that looks at a subsidiary of the company, how we handle that. So the first couple of slides here talk about just some general things that are different about standard opinion letters for public clients. So the first thing is they have to have both the words registered and independent in the title of the opinion. They are addressed to the shareholders, the board of directors, and you could add additional parties if that's appropriate. This is critical. They have to reference the auditing standards of the PCAOB. That's the government entity that was established as part of the Sarbanes-Oxley Act to oversee the accounting profession for publicly traded companies. It needs to, as the opinion letter for private companies does, it also needs to provide a discussion of auditor and management responsibilities. I'll show you an example of that. And then this is critical. It has to have a paragraph talking about internal control and whether it references that separately or if it was an integrated audit. It could include, doesn't have to include, but it could include a critical audit matters section, and I'll talk about that more shortly. It includes a statement on the year the audit firm began serving the client. It's signed with the name of the firm, not an individual, in this city with the primary responsibility for the audit. And then, as was the case with private company, it's dated no earlier than the date with which we have sufficient evidence to support the opinion. That's the same as with a private company. So all of those items there are going to be what's at the bottom of the report. That's where that, in the statement of the year that we began, the signature, the city, and the date will all be at the bottom of the opinion letter. So one thing that is different about public opinion letters is that it starts with the opinion. And if you read through the opinion here, it's not really worded much differently than the opinion for private clients. It says what we have audited, which financial statements we looked at, and for what periods. And it concludes with, do we think, is our opinion that they present fairly in all material respects, blah, 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 in conformity with some framework. In most cases, it's the accounting principles generally accepted in the United States of America. And again, that is kind of a broader, more user-friendly term than GAAP, or generally accepted accounting principles. There's an additional paragraph that references internal control. And again, this is a requirement that's different for public companies than it is for privately traded companies. So that's important. Notice that it references this standards from the Committee of Sponsoring Organizations for the Treadway Commission. That's the entity that established internal control requirements. It gives the basis for the opinion. This is where it talks about management's responsibility, that they're responsible for the financial statements and the auditor is responsible for auditing those in accordance with rules and regulations of the SEC and the PCAOB. Here's a lengthy paragraph that talks about what the auditors did, the kind of steps that they took, examining on a test basis, evidence regarding amounts and disclosures, so forth. So, and again, it restates their opinion. Now on to critical matters. So according to the PCAOB, a critical matter is any matter that arises from work being done during the audit. So that's a possible critical audit matter. And the first threshold is, did it rise to the level where it was required to be communicated to the audit committee at the company? If it wasn't, then it's not a critical matter. So if it is, then the next criteria is, does it relate to assertions or disclosures that are material to the financial statement? So if it's something that's very minor, it's not a critical matter, you can move on. If it is material, then we need to go to the next criteria. Does it involve a matter that is challenging, subjective, or required complex audit or judgment on the part of the auditor? If it is, then we would need to include a critical audit matter where we would explain that issue to the readers of the financial statements or call attention to it. That paragraph, the critical audit matter paragraph, would include an identification of the matter under discussion, the principal considerations about that particular matter, so describing it in some detail, and then describing how it was addressed in the audit, just to make sure that that is brought to the attention and not buried in a footnote somewhere. Now, different types of unmodified opinions. I've seen the word unqualified as well, which strikes me as a negative term, but it's another word for a clean audit opinion, which if you're a controller or a CFO, that's your objective, is to get a clean audit opinion. So unmodified or unqualified are good in that case. So the first one, standard, is where it's just a clean opinion and there are no caveats or other items that need explaining. The second type of unmodified opinion there is where we would have an emphasis of matter paragraph. So there's maybe a change in accounting principles. They went from FIFO to LIFO, and we would talk about that change and the impact that it had on the financial statements to bring that to someone's attention. Another would be an other matter paragraph. So that's disclosing more information than might be in the footnotes to the financial statement about items that we think rise to the level of needing to be communicated to readers from that standpoint. And then we might have an unmodified opinion on group financial statements, and I'll talk about that more in a little bit as well, but that's where more than one accounting firm was involved in doing the audit, and we may want to describe that for readers, and I'll talk about that at the last slide of the presentation here. One of the things that we might want to bring to the reader's attention is a going concern disclosure. So the thing to think about this is accounting standards and asset valuation in particular are based on an assumption that the business is going to remain in business, that it's going to keep producing products, providing services. If you think about taking a value of an asset, say I buy a custom piece of machinery that makes parts for my company to make a larger product for my customers. Well, that custom piece of machinery, I'm going to value that at the cost that I incurred to build the machine or acquire it, and I'm going to spread that cost over the period of time in which I am going to use that machine. That's the valuation, and the impact on the income statement is depreciation. So that value assumes that I'm going to keep running that machine for the estimated useful life of the machine. Okay, and the value that I have on my balance sheet is the value to the company being able to make those parts. If I instead thought that I was going to be out of business in 3 months, that really turns that upside down. That machine now is really worth what I could get for it in a fire sale. Just saying, who wants to buy this machine? What will you give me for it? An auction or something. So the value is completely different under liquidation accounting than it is under going concern accounting. So if there is a concern that the company may not stay in business for whatever reason, whatever risks it may face, and to be honest, if you are reading the news now, there's a lot of businesses that probably, if their year end was occurring now during this uncertain time, might have going concern disclosures if they've been shut down for the foreseeable future. So the auditor would need to have a paragraph that addresses that talks about management's ability to continue in existence, and we would analyze it in two different ways. We would say, does management have plans for kind of resurrecting the company, securing more capital, whatever the case may be, solving their issues, and then have they actually taken steps to implement that strategy, and is it likely to succeed? I had experience with this when I was the controller for Big Toys in the early 90s. A large company had acquired us and directed us to take a strategy that we fired a bunch of our salespeople, replaced them with new salespeople that didn't know what they were doing yet, and then started developing a new product line, which we later launched. So we reduced our revenues by about 25% and increased our expenses substantially. So we had very large losses. Again, at the direction of our parent company, we were a wholly owned subsidiary. We had debt in the U.S. as a separate entity, so we needed a U.S. audit for our banks, and our auditors saw the losses and felt that they needed to include a paragraph about going concern disclosure. And we went back and forth about that, and in the end, I got them to include some language that said that that they had a going concern issue with our going concern, but that it would be fine if we continued to be funded by our parent company. And really the primary user of the financial statement was the parent company, and they were fine with that. So I have had that happen before. So one of the things that auditors would be required to communicate, as I mentioned earlier, is if there were changes in accounting principles. So auditors are required to indicate when there had been a change in accounting principles and what the impact of that is. Again, only if they have a material effect on the financial statements. And that includes just changes in principles. Like I mentioned before, if we switch from FIFO to LIFO or change depreciation methods or something like that, but it wouldn't account for a change in estimate. So if I've been depreciating a building over 20 years and I decide to change that to 30 years, that wouldn't require a disclosure in this regard. So now on to the negative opinions, so the ones that you want to avoid if you're in a company. Really, everybody wants to avoid these, the auditors as well. So one would be a qualified opinion. So a qualified opinion says everything looks good to us except for blank. So it could be that that we weren't able to get our hands around cost of goods sold because we weren't on hand to audit beginning inventory. So we could say that, in our opinion, the financial statements comply with, generally accepted accounting principles, except for cost of goods sold because we were not able to determine X. So that would be a qualified opinion. And then the reader of the financial statement could determine for themselves how important is that issue to my decision making. Another type would be an adverse opinion. So that's where it states that the financial statements are not in conformity with generally accepted accounting principles. If you're a controller or a CFO and you get an adverse opinion, you should just get up and leave. That's a really bad thing to have happen. So to be avoided at all costs. And last is a disclaimer of opinion. That may be that the limitations, the scope limitations, so the areas that the auditor is able to look at are so significant and so pervasive. Maybe they weren't on hand for ending inventory because they were hired after ending inventory was taken. Very few of the customers returned confirmations. Many of the lawyers didn't return confirmations. So there could be so much missing information that just decide that we don't have enough to form an opinion, and that would be disclaiming an opinion and producing the financial statements. The last thing I want to talk about is work, and this happens quite frequently where a subsidiary might be audited by a different company. And there's two approaches that you can take, one of which affects the opinion letter. So in that case, and I mentioned this a little bit earlier, we might have a paragraph that talks about that the audit relied upon work done by another auditor, we would identify who that auditor is and then state either by a percentage basis or a dollar basis the extent of their responsibility for the audit. So we could say we performed the audit, and part of that included hiring Frost & Company to audit our Olympia subsidiary, which accounts for 25% of the assets of the company, that sort of thing. So it kind of indicates shared responsibility, that we're responsible and they're responsible for part of it as well. It's kind of a liability type of thing. The other route to go, either because maybe the subsidiary is immaterial to the overall scope of the audit, or maybe the auditor that audited the subsidiary was hired by the primary auditor and supervised by them. There could be other reasons that the primary auditor decides to take full responsibility. In that case, they don't reference the other auditor. They just indicate that they've done the audit. They have responsibility for the whole audit. So that's the end of Chapter 17. As always, if you have any questions, please give me a call or send me an email. I'd love to hear from you. Take care.